As I promised in my last video, I'm going to show you my bearish step-by-step trading process on the Australian dollar. If you have watched my previous videos, you know that I always start my trading process by determining the higher time frame directional bias. I use my bearish conditions to figure out where price is likely to trade to next and/or where the market is likely drawing to. Here's my step-by-step process for determining if the higher time frame directional bias is bearish. I start the process by picking a market that I want to trade. As you learned in my last video, I always take my short-term trades on the contract with the highest volume and open interest. In this video, we will look at the Australian dollar December futures contract, which has already expired. When I'm backtesting the futures markets, I use barchart.com to check the volume indicator for a specific day that I want to analyze. I compare 2 or 3 consecutive futures contracts to see which has the highest volume and open interest. For this example, we'll examine a trade that happened on 9th of December. That is why I'd look at the December and March futures contracts to decide which one I'd sell short. You can see that the December contract has a volume of 135,000 and an open interest of 176,000, both higher than the March contract, which has a volume of 39,000 and an open interest of 37,000, so I choose to analyze the December contract. After picking the market, I check its seasonal tendencies. Here we can see the 36-year seasonal tendencies of the Australian dollar futures. We can see that the Australian dollar usually drops sharply at the beginning of December, meaning that we can start looking for our bearish conditions to provide a narrative in which we can identify bearish patterns to execute on. Once we identify the bearish seasonal tendency, we proceed with the top-down analysis. We always start with the monthly chart and then repeat the same process on the weekly, daily, and 4-hour charts. I always start by noting the current trading range and asking myself where have we recently traded from. After that, I proceed to the most important part of the top-down analysis, determining institutional overflow. If up-close candles are resisting price and/or large candles form with down closes and/or price has recently reacted bearishly on a premium array, for example price has a sharp rejection after trading above an old high, institutional overflow is bearish. In practice, this looks like this. Thanks to seasonal tendencies, we know that the Australian dollar is historically bearish at the beginning of December. To further increase our odds of success, we determine whether institutional overflow is also bearish. We use top-down analysis to confirm if institutional overflow is indeed bearish, and we always begin with the monthly chart. Like I mentioned in the last video, whenever I look at the chart, I immediately refer to the up-close candles and inefficiencies. Are they resisting price? In this case, we can see that they are in fact resisting price time and time again. I also check if price is unwilling to move higher after trading above a short-term high. I want to see price rejecting old highs and forming large down-close candles. We can see that this is also true. This means that the monthly institutional overflow is bearish. Once monthly institutional overflow is determined, we carry our monthly PD arrays to the weekly chart and continue our analysis there. Here we can see the monthly PD arrays on the weekly chart. Our objective is to determine once again if institutional overflow is bearish on the weekly chart. We can see that price traded above the weekly relative equal highs and into the weekly fair value gap CB, and then broke lower. We get a shift in market structure, which later becomes a bearish breaker block, which is overlapping with the weekly fair value gap CB. The breaker and the fair value gap push price lower. Large candles form with down closes, followed by a 2-week consolidation with smaller range candles, creating a weekly bearish order block. Price then expands lower again, forming another large down close candle. After that, we get an immediate rebalance as price trades into the bearish weekly order block. The order block resists price, sending it lower and ultimately taking out the weekly relative equal lows, or sell-side liquidity pool. And here's a close-up of the current weekly trading range. After determining the weekly overflow, we carry the weekly PD raise to the daily chart and repeat the process there. Here is a close-up of the daily chart. We can see that up-close candles are resisting price and large candles are forming with down closes. Price shows a sharp rejection after trading above a short-term high. Institutional overflow on the daily chart is bearish. Monthly, weekly and daily institutional overflow is in sync, indicating high probability bearish conditions. We can now drop into the 4-hour chart, our lowest higher time frame chart, and further refine our short trade idea there. Here is the 4-hour chart. As on the monthly, weekly and daily charts, we first check if up-close candles are resisting price and if large candles are forming with down closes. We also look for sharp rejections when price trades above short-term highs. Here we can clearly see these conditions forming, confirming that the 4-hour institutional overflow is bearish. If the higher time frame institutional overflow monthly, weekly, daily and/or 4-hour chart is not true or not clear, the higher time frame is neutral. Wait for the opposing conditions to be true or for the above conditions to form. Do not do anything for now. Once institutional overflow is determined, I refer to the Commitment of Traders report. As we can see, commercials have been in a net short position since the end of September, all the way through to the middle of December. They are also heavily short if we look at the commercial hedging program, which further increases the odds of success for our short trade idea. Since commercials are in a short position, we can now look for intermarket relationships to confirm our short trade idea. I always start my intermarket analysis by referring to the dollar index. Since I'm looking to short a foreign currency, the Australian dollar, I want to see bullishness in the dollar index or a risk-off environment. The first thing I notice is the SMT between the dollar and the Australian dollar on the weekly chart. This marks the start of a major move. The dollar sharply rallies, and the Australian dollar sharply declines after taking out relative equal highs. Since we are looking for a short at the beginning of December, we'll focus on that time period on the daily chart. Here we can also see the SMT. The dollar index takes out the low, while the Australian dollar is unwilling to make a higher high. This indicates that the Australian dollar is really weak and ready for the next move lower, fulfilling our higher time frame objective. For timing purposes, we also look at the 4-hour chart. And again, we see the SMT between the dollar and the Australian dollar. This time, the dollar index is unwilling to make a lower low, while the Australian dollar takes out the short-term high. We can classify this as a turtle soup setup because all of the above conditions are met. Seasonally, the Australian dollar is bearish at the beginning of December. Higher time frame institutional overflow is in sync and bearish. Commercials are in a net short position, and intermarket analysis supports our short trade idea. When trading the Australian dollar, I also refer to the New Zealand dollar for intermarket analysis. Here, we also see the SMT between the Australian dollar and the New Zealand dollar. The New Zealand dollar is unwilling to make a higher high, while the Australian dollar takes out the short-term high. This further confirms our anticipation that this is a turtle soup. Intermarket analysis supports our short trade idea. We can now proceed to the pattern recognition stage of my trading process. I have three precise ways of identifying support and resistance patterns, and until at least one of the bearish patterns materializes in price action, I do not do anything. Here are the three bearish patterns. First is the internal range liquidity. Second is the external range liquidity, and third is the bearish breaker that I can use to either pyramid my position or if I miss the turtle soup entry I can enter it here. Each pattern is unique, but they are actually all connected to one another. In other words, when price trades above the old high in pattern number 1, that becomes the turtle soup, or my bearish pattern number 2, where I can now look for a trade setup on the lower time frame. And if I miss the entry on the turtle soup or I want to pyramid my position, I can wait for the bearish breaker, and once I get a bearish breaker, there is usually a lower time frame optimal trade entry that overlaps with that breaker, and I can repeat the described process if I want to further refine my entry points. As long as I get the higher time frame direction right, these patterns provide me the lowest risk rates with the highest probability of success. If you have watched my previous videos in this mentorship, you have likely already identified the ICT bearish pattern number 1 on the 4-hour chart. Price trades above an old high into the 4-hour bearish order block, closing in the 4-hour fair value gap and trades into the optimal trade entry levels. For additional confidence, we see that our PDRAs overlap with the new week opening gap, as well as the weekly bearish order block. The high of the retracement is called by the consequent encroachment of the 4-hour wick. After that, price sharply declines to take out the sell-side liquidity pool that we identified on the monthly chart. As soon as we identify one of the bearish patterns in price action, we proceed to the execution stage of my trading process. Here is the detailed step-by-step process that I follow for my executions. At this stage, I determine my entry point, define my risk, and identify where I will take profits. I can take my trade on the 4-hour and or 1-hour chart. In this case, I will place my limit order at the weekly bearish order block, which overlaps with the new week's opening gap low. This level is also just above the lower quadrant of the 4-hour fair value gap and just below the 4-hour order block. My stop loss would go above the 4-hour short-term high. Here is where I will take profits. Since we are trading in the direction of the monthly, weekly and daily institutional order flow, I would look to take profits at higher time frame inefficiencies and or higher time frame old lows. I always split my position into thirds or quarters and scale out as the market moves in my favor. In this case, I would take my first partial profit at the previous week's low, which would give me a risk to reward ratio of 2.63. My take profit would be below the old monthly low. I would use the swing projections from the intermediate term low to the intermediate term high. The 0.25 swing projection below the old monthly low would be my final take profit, giving me a risk to reward ratio of 3.36. When taking profits, I follow Mark's advice from his book Trading in the Zone. He states that ideally your risk to reward ratio should be at least 3 to 1. I do take trades with a risk to reward ratio of 2 to 1, but only on the 4-hour and sometimes the 1-hour chart. However, I skip trades on intraday charts if the risk to reward ratio is less than 3 to 1. If I want to refine my entry points and minimize risk, I use 4-hour and or 1-hour levels as a basis to look for lower time frame patterns to execute on. I look for the same three bearish patterns on the 30, 15, 5 and or 1 minute charts. Here we can see the 1-hour chart. As I mentioned earlier, when trading the ICT bearish pattern number 1, once price trades above the swing high and into the buy-side liquidity pool, that becomes a turtle soup. As soon as that happens, we can drop into lower time frame charts and start hunting for our bearish patterns to execute on. Here we have the 15-minute chart. We can see the turtle soup, where smart money builds their short position. Price trades above the 15-minute short-term high and then breaks lower. When this happens, we get a change in the state of delivery, and we can look to short at the open of the 15-minute bearish order block. For additional confidence, we also have 2 consecutive volume imbalances right at the high of the new week's opening gap. I would place my limit order at the 15-minute bearish order block and my stop loss at the impulse swing high. This is a 4-hour turtle soup entry because it is above the 4-hour short-term high, combined with the 15-minute fair value play, inefficiency and bearish order block. Here is where I will take profits. As I mentioned earlier, since we are trading in the direction of the monthly, weekly and daily institutional order flow, I would look to take profits at higher time frame inefficiencies and or higher time frame old lows. In this case, I would split my position into thirds and scale out as the market moves in my favor. I will take my first partial profit at the previous week's low, which would give me a risk to reward ratio of 8.9. My second partial profit would be at the old monthly low, for a risk to reward ratio of 10. And I would take my final profit at the 0.25 swing projection below the old monthly low, which would give me a risk to reward ratio of 11.35. Here you can truly see the power of refining your entry points. Not only do you minimize your risk, but you also maximize your rewards. After I enter my trades, the trade either works or it doesn't. In any case, I go on to the next trade and I repeat the described trading process. I know that individual trade outcomes are independent and random, but over a series of trades they produce consistent results. That is why I always trade in sample sizes of 20 trades or more. That way I make sure that I'm thinking in probabilities and judge the viability of my edge based on the results of at least the next 20 valid trades or more. In other words, I determine my success on the results of my valid sample size rather than on a trade-by-trade basis. In the next video, we will study my patterns in greater detail. I'll show you how they're interconnected and exactly how to use them to refine your entries further, minimizing risk and maximizing rewards. Please don't forget to like, comment and subscribe so you don't miss our next upload.